Okie dokie, so this is part 2 of my Exela kind of video series. It's only 2 videos, so I don't really know if that counts as a series. But today we're actually going to be having a look at the financial side of things. If you haven't seen my video about the kind of what Exela actually does, I will leave a link up here so that you can go and have a look at it yourself. Now, Exela has the ticker symbol of XELA. And looking at kind of some of the stats right now, it has a market cap of 111.873 billion. It has a 52-week range of 79 cents to $7.82. And its earnings per share are negative $3.66 per share. Looking at how it's performed in terms of the graph on Yahoo Finance over the past day, it has slowly been climbing. 5 days, it's actually been kind of declining, but it's on a kind of peak up. Over the past month, it had quite a big drop. 6 months, it looked like it had quite a high peak in kind of March for this year, and then it went back down. Over the past year, it's kind of held a value of around $1 to $2. Then if we actually go to the past 5 years, it has had quite a big drop down. When you look at kind of May for 2017, it was at like $9 per share, and it has plummeted down to, well, what it is just now. Who doesn't actually love a PowerPoint presentation? So we're going to have a look at the preliminary fourth quarter and 2020 annual results. Now, this actually isn't their most up-to-date revenue, but it does give us an idea on the kind of, well, it gives us a full year, so we can actually look at the kind of bigger picture. I will actually have a look at the kind of most up-to-date quarter that they had for the start of 2021, but we're just going to kind of quickly go over this. Firstly, revenue of 1.29 billion, a 17% decrease year over year, primarily due to COVID-19. They added 27 million in liquidity, so cash or cash equivalents, to, well, their assets by equity. So they sold more stock, which isn't usually that nice a thing to do if you don't want to, which I think they actually had to. So this is actually quite a nice graph where it actually looks at their market, so their total addressable market, and it will also show you their kind of main customers. So you can see that their main customers are commercial, healthcare, banking, tech and manufacture, P&C, so insurance companies, and then public sector is a very small part, which is kind of understandable because, well, they are kind of a business orientated business. So if you actually look at it of their total market share, they have, out of $207 billion kind of market, they have about 1.3 billion of it. And you can actually see that most of their revenue comes from banking, healthcare, and kind of commercial things. So this actually is quite nice as well, because you can actually see where kind of most of their customers come from. 82% are United States based, 16% are from Europe, and kind of the other 2% are just kind of varied. Then you can also see the types of industries, so banking and financial health, healthcare, and commercial, which kind of links up to where the revenue comes from. You can see where most of their revenue comes from in terms of their customers. So their top 20 customers make up about 34% of their revenue. Then from 21 to 100 is 26. Then from 101 to 200 is 12%. And then all their other customers combined make up about 28%. So by the looks of it, they are quite a big fish company. They look to get really high paying individual businesses compared to just getting billions of really kind of small businesses. Yeah, they have quite long-term customers by the looks of things, or one of their top customers that have an annual average tenure of 15 years. They want to build digital roads between legacy platforms and emerging standards to address the needs of the future. So kind of building automated processes that are more efficient, more streamlined, and much more cost effective than hiring lots of people. So it is quite obvious that they have struggled quite heavily when it comes to Corona, or, well, kind of a more people working from home environment, adoption of the work from anywhere model for Exela employees with possibility to increase to over 50% of employees. Except for senior members, most exempt employees' productivity levels have lowered by approximately 20% or more. Quite a big drop. One of the other things about it is that it plans to exit 35% of its existing facilities. So they are having to kind of scale back quite a bit, and you will see why when we have a look at their, well, revenue. Now, this is actually a really nice diagram because it shows you who their competitors are, and it also shows you that they sit pretty much bang in the middle when it comes to, well, all of these different solutions. So their kind of main kind of balanced competitors between the bills and payments and enterprise software seems to be Coupa. And for bills and payments and BPO is R1. But they do face a lot of competition. And I think that's where they did really struggle as well, especially when it came to Corona, because they sold themselves as a kind of complete package. It wasn't just one thing that stood out. It was the fact that all of it together made automating your business easier. And the kind of main thing I want to actually have a look at is right down at the bottom in the kind of dark banner. Total employees as of December 31st, 2020 were 19,000 as compared to 21,000 from September 30th, 2020. So between September, or the end of September and the end of December, they got rid of 2,000 people. And that's not even kind of including the additional like 600 people they got rid of in the next quarter, which I will show you next. So yes, they have had a tough couple of years and it's not really getting much better for them. If you look at for the customer renewal rates, so this actually shows me that their service must be quite good if customers want to renew with them. 2017 it was 88%, 2018 it was 91%, and 2019 it was 94%. 2020 it plummeted. But businesses weren't actually in their offices, so why would they continue to pay for a service that helps them run a facility if no one can be in that facility? And here we actually have their kind of financial outlook for 2021. Now, we've already had the first quarter of 2021, which I will look at just after this. Their estimated revenue is between, well, 1,250 million and 1,390 million. Gross profit margin is estimated to be between 23 and 25% of revenue. And their adjusted EBITDA margin of 16 to 17% of revenue. So they have had quite a rough couple of years and it doesn't really seem to be getting much better for them. This is their first quarter results for 2021. And yeah, revenue of 300.1 million, which is a decline of 17.9% comparing Q1 of 2020. They had a net loss of 39.2 million. Comparing that to, well, the Q1 of 2020 was 12.7 million. Automation-led efficiencies reduced employee count to 18,400 as of March 31st, 2021, from 19,000 as of December 31st, 2020. So their kind of rate of firing people seem to have slowed down quite a bit. They expanded their financial flexibility, which they desperately needed, with 26.8 million in gross proceeds raised in an equity offering. So they kind of offered more stock, more shares in the company. On the bright side, they had an operating income for Q1 2021 of 4.3 million. When you compare that to last year, they actually had an operating loss of 2.2 million. So they were plus in operating income. So actually having a look at their real estate kind of reduction, 25% of announced reduction in facilities already completed as part of a multi-year plan. So they've most likely done that because operating costs for them are very high with almost 20,000 employees. And they also have well, not really been in need of the facilities if people can't work in facilities. Balance sheet and liquidity. So this is where it actually starts to get quite bad for them. Exela's total net debt as of March 31st, 2021 was 1.48 billion. So they have a massive amount of debt, and when they were trying to generate liquidity from equity, they managed to generate 26 million. And the debt just kind of keeps climbing up. We've already had a look at the kind of 2021 kind of hopes and dreams. But yes, looking at their assets and liabilities on their balance sheets, in total assets for December 31st, 2020 was 1,157,779,000. Comparing that to their total liabilities for December 31st, 2020 was 2,084,311,000. That's quite a big difference. For March 31st, 2020, they actually managed to reduce their total assets by about 53 million. So they have 1,104,722,000. And when you have a look at their total liabilities, they have 2,045,058,000. So their assets reduced about 53 million, and their liabilities reduced about 39 million. For March 31st, 2020, they had revenue of 365 million. Cost of revenue was 292.5 million. For 2021, 300 million, so it's down 65.5 million, give or take. And cost of revenue is also down. So that is kind of a silver lining. So the cost of revenue reduced about the same as kind of what their revenue did. So it's kind of like a 1-to-1. There's not much difference in it. Here we can actually see a breakdown of where the revenue came from. So from information and transaction processing solutions, they made 231.9 million. And for the same in 2020 was 284. So that actually went down. And the healthcare solutions and the legal and loss prevention solutions, well, legal and loss actually only went down by like 0.2, whereas their healthcare solutions went down by about 12.9. So yeah, this is actually quite hard to look at. Yes, XELA is in a bit of a pickle. It is losing money and losing money fast, and it is, well, resorting to, well, cutting quite a lot of its staff. It's kind of getting rid of a lot of the liabilities that it has, or the assets that it has, like its real estate and facilities, and it attempted to kind of mitigate that by selling equity, but it's not really that much. It managed to generate 26 million, which might be able to kind of keep it afloat for a little while, but that debt that it has is just creeping up quickly. Now, the most concerning thing I find when it comes to their, well, assets and liabilities is the fact that in December 31st, they had 68.2 million in cash and cash equivalents, and that has quite substantially decreased to 22 million, give or take. Now, their accounts receivable, which is money that they have yet to receive, is increased by around 10 million or so, from 206.8 million to 216 million. And when you actually have a look at their accounts payable, in December 31st, 2020, they had 76 million, and in March 31st, they have 73 million. So it went down, but it didn't go down by that much. And if you look at all the other columns, they have increased, apart from like maybe a couple. So from my understanding of things, they have a kind of cash problem. They are bleeding money by the looks of it, and their debt is, even though it is going down a little bit, it is still quite substantial. And even if they can pay off the short-term debt a little bit and on time, they will still have to deal with the repercussions of all that long-term debt. So yes, it is quite a tricky one, I would say. Now, its finances aren't good at all. It's pretty much on the brink of a major kind of liquidity issue. And if it can't find a way to, well, start to reduce that debt, then it's going to find it really hard to generate, well, money from equity in the future. So there's really kind of two ways that it could go. Either we come out of this kind of pandemic and people start to go back in their offices and their facilities. In that case, it might be able to kind of stay afloat because it will have kind of more money coming in, so long as it's not kind of past that point of no return. Secondly, we could stay in this kind of lockdown and it just might not be able to survive, and it won't be able to generate a lot of money by selling more equity because it seems to be a bit like a sinking ship. Now, the question is, can that ship be patched up before it completely goes under? And there is kind of some plus side to this. Right now, it's actually quite a good bargain, well, in terms of, well, its price. Because it's trading at like $1.89 per share, it's quite cheap. And as long as you don't put too much money into it, and you do not over leverage yourself. Oh my God, do not over leverage yourself. It's a big gamble, but its PS ratio, which is something I actually had to look into. So if you actually look at its market cap divided by its revenue, it has a PS ratio of 0.083, which makes it really enticing, but I'm really still not sure. It is a hell of a gamble, and there's a few things that I'm just still not sure about. I'm not sure when this pandemic is going to be over and people start going back to these facilities that buy products from XELA. And another thing is, I'm not sure how many are going to go back, even if they can go back. Thirdly, I just don't know if it is at that point of no return. I don't know if it's kind of debt and what it has just means it can't stay afloat. Even if things were to open back up tomorrow, I just don't know. So if you were investing in it and you did want to put some money into it, just know that it is a massive gamble and there is no way to tell whether it's going to survive, not just based on its finances, but also just kind of in how the world is working right now. I do like the idea of XELA. I do like the idea of the company. Automation and automating workplaces is the future. But I just don't know if it's going to be XELA that can take us there. Just based on the fact that I don't know if it's going to be around in 6 months or a year. But yeah, is it a gamble? Let me know what you think about XELA in the comment section down below. Let me know your points. I probably missed some points, but I would really actually like to know what you think about it. And also please bear in mind that none of this is supposed to come across as investing advice. Please do not base any buying or selling decisions on the content of this video. But that does bring us to the end. So thank you very much for watching. I do hope you have a good day and I will see you next time.